The Canadian real estate market crash is here, with certain markets around Toronto down as much as 30%. But the question is, in the face of rising interest rates, how bad will it get? And in today's video, we're going to discuss all the numbers, all the details, not just with respect to the real estate market, but also with respect to all the other economic indicators that will play an important role in how bad the Canadian real estate market crash gets. But before we get into all the details, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers giveaway. We finally hit 25,000 subscribers and we are giving away $5,000. In order to enter, go to 360giveaway.ca and earn an extra entry by following me on Instagram and also by sharing this contest on your social medias. All right, so welcome back. Today we're discussing the Canadian real estate market crash and all the things that are not just putting pressure on the Canadian real estate market, but also on the things that are propping it up, because there are all kinds of economic factors here and we can't cover them all in a single video. However, we can discuss the things that are going to help and the things that are going to hurt and how much there's going to be an effect on the Canadian real estate market. And first and foremost, we have to talk about interest rates because obviously that is the big topic of conversation. And with the basically 2% increase in interest rates over the last couple of months, we can pretty much guarantee that that's going to be about a 20% downward pressure on purchasing power in the Canadian real estate market. And therefore, that is the primary headwind that we are facing. And it is the reason why we're seeing certain markets across Canada with real estate values that are starting to come down, especially markets that didn't really have the fundamentals to support their rapid price growth to begin with. These are the areas in and around Toronto, and in some cases Vancouver, that saw skyrocketing prices as a result of basically this pandemic frenzy. Now, even with that 20% headwind, that isn't to say that housing prices are going to come down 20% across Canada, because they probably aren't. And there's a whole bunch of reasons for this, but they include a really interesting factor, which is called the lock-in effect. And we've seen this in Calgary with properties that were bought at the top of the market in 2006 that are still being held by buyers because they were waiting simply for the market to catch up to the downturn in the market. And the lock-in effect is essentially this. This is when people purchase properties and then when the market turns, they tend to hold on to them rather than sell them. And there's a whole bunch of reasons for this. The first is that they can become underwater on those properties. So in other words, they owe more than what they can sell the properties for. The second, and a very common effect in Canada, especially if you have a 5-year fixed rate with a big bank, is the payout penalty effect, where you have a significant penalty and therefore you cannot sell the property without paying these massive penalties. And therefore people tend to hold those properties to avoid those big payouts. And the third has a lot to do with investors, and that is essentially the tendency to hold properties that have basically lost value in order for them to eventually come up, especially with long-term investors who are expecting that values will increase over time. And this lock-in effect essentially creates a scenario where when you see a reduction in interest rates by 1%, you would expect a 10% increase in purchasing power and therefore a 10% increase in housing prices. Well, the other way around, it doesn't necessarily go the same way, because even though we have a 10% reduction in purchasing power, if we have a 1% increase in interest rates, we have this tendency for people to lock in their purchases and not want to sell. And that's going to be something that we're probably going to see in the very near future, is we're going to see a lot of people who just refuse to sell their properties because they don't want to lose money on them. By the way, this is really typical in cottage areas and recreational property areas. What tends to happen is when home values in these types of areas start to go down, they are typically held up by homeowners who own multiple homes and therefore choose not to sell those properties because they can afford to have that second property, choosing to wait out the market rather than sell the properties and have an actual correction when typical market fundamentals would dictate that there should be one. Now, while rising interest rates are the big headwind and the lock-in effect is going to reduce the effects of the higher interest rates, there are a whole bunch of other things that come to mind with respect to the Canadian real estate market that we have to factor in. And I've put together a series of graphs and a series of information on all the things that you should be considering when you're assessing the Canadian real estate market. So let's jump into that right now. We're going to jump into the graphs, and let's start first and foremost with consumer confidence in Canada. Now, there is no doubt we are seeing slumping consumer confidence due to higher interest rates, due to the falling real estate market. But if you take a look at where consumer confidence is now compared to where it was pre-pandemic, we're returning to more normal levels, and this was to be expected. And not only are higher interest rates contributing to that slump in consumer confidence, but so is price inflation. And as you can see, we are seeing significant price inflation at some of the highest levels since 1991. In fact, the last time we got even close to 5% inflation was in 2004. So we're seeing higher prices at the pump, at the grocery store, pretty much across the board. And that is obviously leading people to worry about whether or not they're going to be able to make enough money to afford their cost of living. Now, combine all that, the higher inflation and everything else, with the fact that we've got this Ukraine and Russia war, which is essentially causing inflation to embed even further than it already had. And this is having a significant impact on the prices of pretty much everything worldwide. And by the way, one thing to consider is that Canada's inflation compared to the rest of the world is still quite low. We have done an exceptional job of managing inflation in this country, regardless of what politicians would tell you. And you can determine that for yourself by simply going ahead and taking a look at inflation rates worldwide. And you can see that we are on the lower end of the spectrum rather than at the top. And the reason why inflation is a problem worldwide is because inflation is very much a supply chain issue. We are seeing inflation in multiple countries. And because we're seeing inflation in multiple countries, that is the key indicator that it is not a homegrown factor. And in fact, that inflation, like I said, is significantly higher than what it is in Canada. Now, the next thing to consider is that we have rising interest rates. And since the beginning of April, we've seen the Bank of Canada already increase interest rates by 0.75%. But if you take a look at this graph, what you'll see is that interest rates are still significantly lower than they were pre-financial crisis. In fact, they are substantially lower. What economists are now expecting is that we're going to have to see interest rates rise past the neutral zone, which is about 3.5%, in order to kick this inflation problem that we have. However, there could be some stops and starts before we get there. But know this, we're still at historically low interest rates, and interest rates that are still comparable to what we were at coming out of the Great Recession. So while we may have some further interest rates coming, we're simply returning to a more normalized interest rate environment as opposed to going to interest rates that are skyrocketing beyond belief. Now, one other thing that we need to consider is the breakdown of home purchases, because there has been a significant change in trends. This data is from Terranet, and what it is showing is that investors are becoming a significant portion of the Canadian real estate market. And this happens anytime that there is a run up in real estate values. And by the way, the people that most often get their butt kicked in a real estate correction is the investors that jumped in as the frenzy started to happen. So by the way, if you bought a house or you're thinking about buying an investment property over the next little while, you're probably going to have to hold that property for a significant amount of time for you to be able to sell it at a profit and have a reasonable amount of cash flow. So if you're buying investments right now, think with the long term in mind, not with the short term in mind. And by the way, if you bought pre-construction, I feel sorry for you. We tried to tell you guys 6 to 12 months ago that pre-construction was a bad idea in this sort of market, and you're probably going to feel a little bit of pain. Now, one thing that hasn't returned to normal quite yet is the sales to new listings ratio. This is still significantly higher than it's been at any point in the last 15 to 17 years. If you take a look, we're starting to come back to more normal levels, which means we're getting into a more balanced market. We're nowhere close to a buyer's market yet, but this sales to new listings ratio is still quite high. It is starting to get a little bit better, but what that tells us is that there's still a limited amount of supply available for the number of transactions that are taking place. And one thing to consider here when we talk about supply, because a lot of people don't believe that supply is the issue, but it is the issue, is we have been building not enough houses since about the 1980s. If you take a look at this graph, what you can see is that our housing completions compared to the population growth in the 1980s was pretty much on par. But since then, we've had significantly more population growth than we have had new housing completions. And in fact, housing starts in 2021 were at an all-time high, which meant we were pretty much building at capacity in 2021. Which means if we're trying to get supply online and we were already building at capacity, we have a long ways to go. And the only way that we are going to build more houses is if we get more skilled workers available to help build those houses. And that is simply not happening because there are so many other jobs available to them in the economy. And that lack of skilled workers and the abundance of new jobs that are available has led to record tightness in the jobs market. If you take a look at the numbers right now, we are at an all-time low from an unemployment perspective. So in other words, there are more people working right now that want to be working than at any other time in Canadian history. And that has actually led to stalling job growth because we don't have enough people to fill the jobs that we already have. So if we don't have enough people to fill the jobs that we already have, that leads to rising wages. And And if you take a look at wage pressure as of right now, we're starting to see significant wage pressure. And what wage pressure is that is when wages are increasing, and they're going to continue to increase with inflation. Now, they may not follow at the same level of inflation as of right now, but wages are certainly increasing pretty much across the board, which means that affordability is going to come back a little bit in the real estate market, and that is going to support the real estate market to a certain extent. Now, the one thing that we have to factor in though is that home prices have significantly outpaced wages in Canada. And this is a significant problem because even if you compare to the US has not had the same issue. But in Canada, our housing prices have gone up substantially while our wages have not gone up as much. And this obviously has a lot to do with certain markets that are considered highly unaffordable, specifically Vancouver and Toronto, which have a lot of foreign buyers. In fact, those two markets are seemingly becoming international markets, not local markets, as borrowers and buyers from other countries come in to purchase property in those high-performing markets. But what becomes really interesting is this, is Canada has two of the most unaffordable cities to live in the world, two of the top 10. In Toronto and Vancouver. In fact, Vancouver is the third most unaffordable city to live in the world. But if you look at the other side of the chart, we also have two of the top 10 most affordable cities to live in the world in Calgary and Edmonton. And while housing prices have outpaced income, we're still getting to the point where we have significantly more disposable income than we've had in years past. In fact, this has spiked quite substantially, and that is due to monetary policy and the fact that we've had a significant amount of money injected into the economy. And what's interesting here is that even if you take out COVID supports, disposable income in Canada is going up quite substantially, which is a good thing, and that will support housing and it will support the economy. On top of that, 2020 was a huge eye-opener for the Canadian economy and for Canadians in general with respect to debt. And we have seen Canadian credit card balances go down substantially because people realized that it just took one little illness, one little sickness to basically kick our butts and make it so that we couldn't pay our bills. And therefore, people have stopped spending on credit cards in the same way that they have in the past. Now, that problem is coming back. People are getting back into their old habits, but the smart ones will continue to not spend as much money on credit cards as they have in the past. Now, on top of better economic circumstances from a wage perspective and from a liabilities perspective, we've also got the fastest growing country in the G7 and one of the fastest growing countries in the world from a population perspective. Now, where are we going to put all of these people? Because we aren't building at the same rate as what we are increasing our population. And if you look at the forecasted immigration numbers, this problem is not going to get any better. In fact, the problem is only going to get worse. We are not adding enough housing supply to the economy in order to support the number of people that we're bringing into the economy. So while we'll see some pullbacks in certain markets like Toronto and Vancouver, you can probably expect that more affordable markets like Calgary, Edmonton, Regina, Saskatoon, Manitoba, and eastern provinces are probably going to fare okay in the next little while, especially as we continue to have higher wages and higher job growth and so on and so forth. This is going to be something that we have a significant problem with for a long, long time. And the fact that we don't have enough houses to support the people that are coming into the country is a pretty good indicator that our housing market is going to remain pretty flat for a pretty significant amount of time. So to sum this whole thing up, we've got this pretty significant headwind of interest rates that is coming to the Canadian real estate market, but we've also got a lot of wage pressure, we've got job pressure, we've got all of these things that are also supporting those higher real estate prices and those higher real estate values, especially in markets outside of Toronto and Vancouver. So while we may see a correction in those big markets, and by the way, I doubt it's going to be a big correction just simply due to the lack of supply, well, the prognosis for the Canadian real estate market is still strong. It's probably going to stay flat for a continued amount of time unless something that none of us are expecting comes up, slaps us upside the head, and totally corrects and crashes the Canadian real estate market. So with respect to how bad it's going to get, all the data with respect to wages, all the data with respect to jobs, all the data with respect to immigration, they all tell us that there is significant support for the Canadian real estate market and the Canadian economy, and the fact that our inflation is nowhere close to as bad as other countries around the world. And it is clearly a global issue, not a local issue. Well, the Canadian economy is going to bode pretty well for the next little while. So while the crash is here, it's probably more of a correction. It's probably only in the big two markets, and we're going to see some pretty significant supports for the economy and for real estate prices for at least the next 3 to 6 months, if not significantly longer. And only time will tell, because I don't have the most clear crystal ball, even on the best of day, what's actually going to happen in the Canadian real estate market. But right now, it seems like the fundamentals are there to support continued high values in the Canadian real estate market. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers at 360giveaway.ca. We'll see you on the next video. Cheers.